Hi, I'm David Scranton, and thanks for clicking this video because today we're talking about the stock market and its wild roller coaster ride last month. But the question becomes, will it continue into the spring? To help us with that question, now it's time to bring in today's guests. Jeff Small, president of Arbor Financial Services, a retirement income store located in Melbourne, Florida. Jeff, as usual, great to have you here to talk about the markets.
It is awesome to be with you guys today, Dave.
And of course, now I'm happy to be able to introduce one of our frequent guests, today's special guest, Jon Najarian. He's an options trader, and he's co-founder of Market Rebellion. He's also the co-author of the book, Follow the Smart Money. Jon, once again, our pleasure for having you here with us.
Oh, thank you, David. Jeffrey, always fun to do your program.
Jon, here we go again. I feel like we keep having the exact same conversation. The market's even become more bipolar. You know, a good portfolio manager only has to be right 60% of the time. But I want to talk about something that's near and dear to your heart. You help investors all across America every day through marketrebellion.com and on CNBC. So tell us what investors should do today going forward in this tightening environment with rising rates and rising inflation, because the dynamic has completely changed.
Yeah, I think you're correct, of course, that dynamic has changed. I would basically zoom out, look at the bigger picture rather than zooming in, because on a day-to-day basis, if you trade like I do, then you have to zoom in. And I wish I could be more like many of your viewers, most of your viewers probably, and take that, again, zoom out picture, because the market is still in that same uptrend, Jeff. It's just we're seeing a lot of back and forth. Is the Fed going to overreach? Are they going to throw a 50 basis point rate increase? Right now, the 10-year bond's saying no, they're not. So I think the 2-year bond, because we always look at the 2-year versus 10-year, and again, that's because we're zoomed in. If you zoom out, what you've really seen is interest rates are really low. Corporate earnings in most cases have been spectacular, and they should more or less not pay attention to the noise of the day-to-day trade every day, Jeff.
You know, recently, Jon, you said on CNBC, the Fed has to talk like a hawk. And of course, it worked in most of 2018 when they were trying to raise interest rates until, of course, December when it didn't work anymore. So putting the talk aside, do you think that, do you think they're going to be able to do 3 or 4 interest rate raises this year? I know before you didn't think so. Has your thought changed at all?
No, I am still in that 2 to 3 camp, David and Jeff, and I think they'll be lucky to get those in because we're just in the midst of an ADP report, which was dismal. Certainly the worst of President Biden's tenure and the worst in a very long time. In other words, whether it's Omicron, whether it was vaccine mandates, whatever, we saw private payrolls just dropping like crazy into the negative territory. And so I don't think that you're going to see those 4 and 5 rate increases that people that want to grab headlines say that, but I don't think they believe it either. I think the Fed will be lucky to get away with 2 rate hikes this year. And if inflation stays as high as it is, the inflation that they can control, that is, then I think maybe they throw a 3rd at it, but that's as far as it goes.
Yeah, because half the problem with inflation right now is still the supply chain side. And of course, as you know, the Federal Reserve really doesn't have a tool to fix the supply chain side. They only have a tool to fix the demand side.
Correct. And that supply chain side is still disrupted. It's getting better, but it's still disrupted. And the last thing you really want to do when people are paying higher prices for food, higher prices for gasoline and so forth, is throw an additional speed bump at them with higher interest rates. So I think it'll be a gradual, not a leap higher in interest rates.
John, the Fed is behind the curve. They didn't get ahead of inflation, and now we have excessive inflation, and they're going to try and catch up too quickly. So that's going to affect investor portfolios significantly if they over-tighten. You said in our last segment, though, only 2 to 3 rate movements, maybe. A lot of financial prognosticators on Wall Street are saying 5 to 7. Why the disparity?
I can't explain other than people grabbing headlines, Jeff, because no right-thinking person really believes that the Fed would basically, you would not only turn over the House and the Senate, but you would have sentiment so negative against this administration if you saw 7 rate increases. I mean, again, I don't think the Fed wants to be political. And if they did such a thing, they would basically throw the baby out with the bathwater. We would see the market down 20% plus. We would see a whole bunch. I mean, what happens when you do that? You have firms hunker down. That means they don't hire. It probably means they lay off. It probably means they cut their spending and all the rest. All of those things are negative for consumers, of course, and the three of us care a lot about consumers. And what we don't want to see is the Fed overreach like that. So somebody saying that, I can't believe they really believe that in their heart of hearts. You're right. The Fed did wait too long, and they did use that transitory term way too much. But now the damage is done. Inflation's been here for quite a while, and it's just a question of, do they want to make it worse?
Well, it's funny because if you think back to even 2018, they were only able to get federal funds rates up to, I believe, 2.25 before the bond market really jumped in and said, you're not going to do this anymore. And now, of course, we're 5-6 trillion in the hole, further in the hole than we were back then. So can they even get to 2.25, even if they try to over the course of a few years? I don't know.
Well, and like we said in the first segment, we've seen the 2-year, and traders always look at that relationship, the 2-year to the 10-year. And as that 2-year keeps moving up, and the 10-year is actually down in the last couple of weeks, down, even though we've had all this tough talk. So like I said, the Fed will have to talk like a hawk, but I don't think they'll be able to walk that walk, David.
So what are some of the other factors, and what do you tell average income generation members? You know, we've got this thing right now with Russia. We've always got these COVID variants. We've always got this thing hanging over our head that, God, the market's been going up for so long, it's overdue. When you take all that, you put it in a blender and you push the button, you know, what are the biggest risks and what's the best advice you have for those retired or within 10 years of retirement?
Well, I'd say when you're talking about the first issue there, Russia, all the more reason to be in energy stocks, because if there's a disruption, if there's an incursion by Russia, as the president called it, a minor incursion into Ukraine, prices are going to keep moving higher for energy. So what would I do income generation wise? I'd own Exxon, and I'd own a number of other energy production stocks in America. I know they have exposure elsewhere, but I would focus on America, high dividend yields. And for those of them who actually choose to learn a little about options, they could easily take that into double digits as far as the return on that. Sure. And I think that's going to be very attractive in 2022.
Sure. Great. I love your recommendations. You know, stick with dividends. That way there, even if you're wrong on the oil side, that's okay, because you're still getting good income. You're still getting a good yield. And of course, as you know, when you get into retirement, it's all about the income. So John, Jeff, once again, it's been my pleasure. Great having both of you back here.
Thank you.
Thanks, Dave.
Thank you for watching today's market update video. If you enjoyed it, click the thumbs up button, give us a like, and make sure that you subscribe to our YouTube channel for new content each and every week.